Welcome back to Investing Talk Podcast.
Good to be back.
Today we are doing a deep dive into a company that's, well, been performing incredibly well operationally, but maybe its stock tells a slightly different story lately. Decker's Outdoor Corporation.
That's right. We've gathered a bunch of sources, financial reports, market takes, news bits, and our mission here is pretty straightforward.
Which is?
To pull out the really crucial insights from this material about Decker's recent performance, their financial health, where they fit in the market, and what the outlook might be.
Okay, so we'll be looking at their revenue, their earnings, how the stock's been acting, the power behind brands like HOKA and UGG.
You're up against?
Right, the competition, and what analysts in the market are actually thinking. So let's get straight into those numbers.
Okay, yeah, let's start with the financials because honestly, they look quite strong. Decker's had really solid top-line growth in fiscal 2025 that just ended in March.
And the headline number?
Revenue for the full year hit around $4.99 billion.
Just shy of $5 billion. That feels pretty substantial. How does that compare year over year?
It's a big jump, a 16% increase from the prior fiscal year.
16%, okay.
Yeah.
And quarterly, did it hold up?
Yeah, looking at the quarters, the sources mentioned Q4 revenue was $1.02 billion. That's up 6.5% year over year. And Q3, that was even stronger at $1.83 billion, showing 17% growth.
Okay, so solid growth through the year, really strong in Q3, still positive in Q4. What's actually driving that? Is it mostly one brand or both pulling their weight?
Well, the sources definitely point to both of their big brands.
Yeah.
HOKA revenue, it was up a massive 24% for the full fiscal year.
23%.
And UGG wasn't exactly slacking either, showing really strong growth of 13% for the year.
Those are really impressive rates for brands of that size.
Sure.
Okay, so revenue's looking good. What about the bottom line? Profitability, earnings?
Earnings per share actually saw an even sharper rise. Diluted EPS for the full fiscal year 2025 jumped significantly by 30%, hitting a record $6.33 per share.
Wow, a 30% increase in full-year EPS is, wow, that's really something. I did notice, though, looking at the Q4 earnings specifically, things seemed a little confusing.
How so?
Well, one source mentioned Q4 EPS was like funny 56 cents, which looked like a pretty steep drop, maybe 31.7% from 0.80 cents the year before.
Okay.
But then another source said Q4 EPS was $1 and that it beat analyst estimates by a good chunk, like 0.45 cents. How do those pieces fit together?
That's a really important point to clarify, and yeah, the sources help here. Well, one specific reported Q4 fee might show that year-over-year decline.
Right.
The key thing, it seems, for the market was that the company's Q4 EPS may be an adjusted number, or the one analyst's track came in at that $1 mark.
And the beat was the main story.
It seems so. Beating estimates by $0.45 is significant. Plus, context matters. The sources also mentioned they've consistently beaten estimates in the quarters leading up to this one.
Oh, okay.
So yes, we should acknowledge that year-over-year dip in that one number, absolutely. But the bigger picture from these sources is really that record full-year EPS, the $6.33, up 30%, driven by strong sales.
And that Q4 beat against expectations.
And the Q4 beat, exactly.
Okay, that clears it up.
Yeah.
So record EPS for the year. With that in mind, what's the valuation looking like based on the sources?
Well, looking at the stock price, it was around $126 when this info was current. Paired with that $6.33 trailing EPS, the sources put the trailing TE ratio near 20 times.
And how does that stack up?
They note it's generally in line with, or maybe slightly above, industry peers in footwear and apparel. It suggests the market's willing to pay a little extra, probably for that growth we've been talking about.
Makes sense. And the company's financial footing, are they loaded up with debt or?
Seems like the opposite. The sources describe the balance sheet as superb. One specifically highlighted about $1.9 billion in cash and equivalents as of March 31st.
$1.9 billion in cash.
Yeah. While they didn't give exact debt-to-equity figures in these pieces, that description and the cash number imply, leverage is manageable. They've got financial flexibility.
That's definitely good to hear. Gives them options. It's probably worth mentioning these sources didn't really detail things like free cash flow or return on equity.
Correct. You'd need the full financials for that level of detail.
Okay. Let's shift from the pure numbers then. What about the business itself, its strengths?
Well, the brand power is obviously huge. HOKA and UGE, that's a clear competitive advantage. They're making innovative products people seem to want, and that lets them command, premium prices.
And HOKA's expansion.
That gets called out specifically. It's mentioned as undergoing rapid global expansion, getting into new markets.
So they're really establishing themselves, especially in that performance footwear space where HOKA is becoming, well, a real contender.
A major force, yeah. And if you connect that to the wider market, Deckers is definitely riding the wave of demand for athleisure and performance gear.
That trend doesn't seem to be slowing down.
No. The sources also touch on things like sustainability focus in the industry, though not much detail on Deckers specifically. And supply chains are still tricky for everyone.
But that strong balance sheet probably helps there.
You'd think so. Gives them a buffer others might not have.
Of course, it's not like they have the market to themselves. You've got the giants, Nike, Adidas.
Absolutely. And then all the newer direct-to-consumer brands popping up too. It's competitive.
Okay, now let's pivot to the stock performance itself, because this is where, like you said earlier, it gets a bit puzzling compared to those strong financials.
It really does. Over the past year, ending around May 2025, Decker stock actually went down. It declined by about 21.4%.
Wait, down over 21%?
Sure.
When revenue grew 16% and full-year earnings jumped 30%? That feels odd.
It's a definite contrast, and the sources mention this disconnect. The stock's been under pressure even with great brand results and financial growth.
Any specific reasons given?
Not one single smoking gun across all sources. Could be broader market worries, especially around consumer spending stocks, or maybe some investors are still cautious about that specific Q4 EPS year-over-year dip we discussed, despite the beat. Whatever the reason, it's clearly underperformed. The S&P 500 was up around 8.4% in the same period, and the consumer discretionary sector ETF was up over 12%. So yeah, Deckers lagged.
That gap between how the company's doing and how the stock's doing is definitely food for thought. But you mentioned flexibility as the company using its resources to support the stock. Buybacks?
Oh, absolutely. They're actively returning capital. The sources highlight they bought back about $567 million worth of shares in fiscal 2025.
Okay, that's substantial.
And very recently, just on May 22nd, the board okayed a new stock buyback program, a big one, up to $2.25 billion.
Wow, $2.25 billion. For a company their size, that's a huge authorization. That must signal some confidence from management.
It certainly sends a message, and it could offer real support for the stock price moving forward.
Okay, so let's try and wrap our arms around this. Key strengths based on what we've seen.
You've got that strong brand portfolio, right? HOK and UGG, driving industry-leading growth. You've got the robust overall revenue growth, record full-year EPS.
The history of beating estimates.
Yep, beating estimates leading into Q4, a really healthy balance sheet, loads of cash, and now this clear commitment to buybacks.
Lots of positives. But on the other side, the red flags.
Primarily that stock underperformance over the last year relative to the market, and that Q4 EPS year-over-year comparison point we keep coming back to, which some might see as a hint of margin pressure or rising costs, even with the beat.
Got it.
And then there are the broader risks flagged in the sources, things like near-term uncertainty, the global trade situation affecting supply chains, potential regulations.
And analyst concerns.
Specifically about HOK, can it keep up that really high double-digit growth rate as competition gets tougher? That's a key question analysts seem to be asking.
Makes sense. Anything else on the risk front? Lawsuits, scandals?
Nothing like that mentioned in these sources, which is good.
Okay. But there are opportunities too, right?
For sure. Continued international expansion for HOK is seen as a big one. Lots of potential upside there. And again, that strong balance sheet, the $1.9 billion cash, plus that big buyback program gives them firepower.
Supports shareholder value, provides flexibility.
Right. Looking ahead, what are the catalysts? Well, the next quarterly earnings report, probably June or July timeframe, that'll give updated guidance, which everyone will be watching closely.
Okay, product launches.
Continued innovation, absolutely, especially in HOK running shoes and whatever UGG comes up with next. Those will be important.
Now, putting Deckers in context, how do they compare size-wise to the big players? You mentioned Nike, Adidas.
Yeah, based on the market caps mentioned, Deckers is around what? $16.6 billion. That's obviously much smaller than Nike, over $200 billion, or Adidas, around $50 billion. Even VF Corp is bigger, around $40 billion.
So they're playing in a different sandbox almost.
Kind of. The sources suggest Deckers isn't trying to be everything to everyone like the giants. Their edge comes from leading in specific niches with these high-growth specialty brands like HOK. It's about focused innovation and brand appeal in their segments.
A different strategy. Okay, so given this whole picture, strong results, weak stock, Risks, opportunities, niche position. What was the overall recommendation from the source that provided one?
The recommendation summarized was hold.
Hold. Okay. Not buy, despite the numbers, not sell, despite the stock drop. Why hold? What's the thinking?
It seems to balance everything we've discussed. The source acknowledges it's fundamentally a strong business, great brands, great growth, solid financials, all suggesting long-term value. But the near-term risks are real. The whole macroeconomic picture, how it might hit consumer spending, and those specific worries about sustaining HOK's super high growth rate against competitors, that introduces enough caution to maybe hold off on a strong buy, hence the hold.
So the advice for someone already invested, according to this source, is basically stick with it for now.
But keep a close eye on things.
Watch the upcoming earnings, see how they're handling the economy, the competition, and especially what happens with HOK's growth trend.
That seems to be the takeaway. Okay, so just to quickly recap the main points from this deep dive, Deckers put up really exceptional full-year results for FY25. Record revenue, record EPS, powered by HOK and UG doing incredibly well.
Yeah, but the company's facing some headwinds. You see that in the stock's underperformance over the past year. It might be broader market feelings, might be competitive heat, especially around keeping HOK's growth engine running so hot.
Definitely. On the plus side, though, they have that very strong balance sheet, lots of cash, and they've just signaled major confidence with that huge new share buyback plan.
So as you think about Deckers moving forward, maybe here's a final question to chew on based on all this. How sustainable really is HOK's massive growth rate with competition ramping up? That seems critical.
Or, maybe from another angle, how well can Deckers use that financial strength, the cash, the buybacks, to navigate any potential economic bumps and keep delivering value, even if the market stays a bit cautious on consumer stocks?
It's definitely a fascinating setup. Strong company performance kind of bumping up against some external question marks.
Indeed.
Well, if you found this deep dive useful, please do subscribe, like the video, and drop a comment below with your thoughts or any questions you might have.
We always like hearing from you.
Thanks for tuning in.